So, Neil, we are in a new phase in the stock markets where bad news is actually bad. Now, it used to be that bad news was good because that meant the Federal Reserve needed to start loosening on those 23-year high interest rates. As you see, the NASDAQ now flirting with a correction, and that means down 10% from those recent peaks that we saw last month. Investors have been selling big tech, and they have been going into small caps and other stocks like industrials. You're not seeing that today. Now, the Treasury action has been stunning, as you mentioned, sub 4% on the 2 and the 10-year yields. And that's because the market now expects the Fed to start cutting rates next month and possibly get aggressive. Remember also that yields go down when Treasury prices go up, the inverse. And that's because there are hints of a possible recession. You use the R word, and investors are rushing and buying into the safety of government bonds, which pushes up the price. Now, Amazon stock is having one of its toughest, roughest days in a year, down on a weakening U.S. consumer. It's set to lose $200 billion in market cap in one single day today. Now, I spoke to Amazon CFO Brian Olsavsky last night on those earnings, and he tells me that they are still seeing cautious consumers. They're looking for deals. They are trading down to lower ASP, which are private label options when they can, because they're usually cheaper. Now, Intel hitting an 11-year low today. Worst day in 50 years, half a century, cutting 15,000 jobs. And this is after a dismal forecast. We know that Intel has failed to keep up and pivot in the mobile and now the AI era. Now, speaking of AI, we do have one outperformer today, and that is Apple, rallying after earnings beat, and that's despite the China miss. iPhone sales decline. Analysts expect artificial intelligence, AI, to ignite an upgrade super cycle. And I spoke to CEO Tim Cook last night, and Cook telling me that on AI, that we would just say that we are spending a lot more year over year. And really, it's a combination of CapEx and R&D. And that's $1 trillion that will be spent in AI over the next few years. Still, if you invested in these Mag 7 names, these big tech names over the past year, you're still pocketing some pretty good gains. Now, after today's jobs report, Wall Street right now thinks that the Fed is going to get much more aggressive, Neil, as you mentioned. You saw Goldman Sachs now calling for 25 basis point cuts, September, November, December, 3 of them. Citi is going even bigger, calling for 125 basis points in interest rate cuts before the end of this year. So 25 in September, 50 possibly to end the year. So 50 in November and December for Citi's call for the Fed.
It is remarkable if you think about it, Susan, because the sentiment was there for cuts anyway, but all of a sudden now you're hearing talk, make them bigger cuts, Mr. Chairman, and maybe start them before September. I think the latter, starting them before September, might get a panicked reaction in the markets, don't you?
Absolutely. And, you want to telestrate, because this forward guidance that we're so used to from the Federal Reserve tells us that they have now put an interest rate cut on the table for September. But if you go before the September meeting, and if you go big before you actually tell it straight to the market, I think that's going to set in some panic, and especially before an election as well, because you really want to tell it straight and message accordingly heading into that November vote. I just want to correct myself there, Neil, for the Citi call. 125 basis points cuts by the end of this year. So they're calling 50 in September and December and 25 in the middle in November.
Wow. That might have the desired effect of what they want to see, but man, the reaction of the markets to that could be anything but